Question 1. What is the primary distinction between a fixed annuity and a variable annuity? A. Fixed annuities provide a guaranteed income, while variable annuities offer income based on the performance of underlying investments. B. Fixed annuities are used primarily for estate planning, while variable annuities are only used for retirement income. C. Fixed annuities are regulated by the IRS, while variable annuities are regulated by state insurance departments. Answer A. Explanation. The key difference between a fixed annuity and a variable annuity lies in how the income is generated. Fixed annuities provide a guaranteed income stream based on a set interest rate, whereas variable annuities income is tied to the performance of underlying investments sub-accounts. This introduces greater potential for growth but also greater risk. Fixed annuities are often used for guaranteed income, while variable annuities offer the potential for greater returns, making them suitable for more risk-tolerant individuals. The other options either misrepresent the uses of annuities or confuse regulatory details. Question 2. Mr. Johnson is 62 years old and is considering purchasing an annuity to supplement his retirement income. He wants a product that will provide a guaranteed income for the rest of his life, but is also concerned about inflation eroding the value of his payments over time. Which of the following would be the most appropriate option for him? A. A fixed indexed annuity with an inflation rider. B. A single premium immediate annuity, SPIA, with a fixed payout. C. A deferred fixed annuity with a guaranteed minimum withdrawal benefit, a variable annuity with an equity sub-account allocation. Answer A. Explanation. Given Mr. Johnson's concern about inflation, a fixed indexed annuity with an inflation rider would be the most appropriate choice. These annuities are designed to provide guaranteed income with potential for growth tied to an equity index, such as the S&P 500, and the inflation rider ensures that payments can increase over time to keep pace with inflation. The other options do not address his concern about inflation. An SPIA offers fixed payouts with no adjustments for inflation. A deferred fixed annuity with a GMWB would not provide immediate income, and a variable annuity exposes him to market risk which may not align with his need for guaranteed income. Question 3. Which of the following is a primary concern when determining the suitability of an annuity for a client? A. The client's risk tolerance and investment goals. B. The total number of annuities the client already owns. C. The client's income tax bracket for the previous year. D. Whether the client has a life insurance policy in place. Answer A. Explanation. When assessing annuity suitability, the most critical factor is the client's risk tolerance and investment goals. An annuity product must align with the client's financial objectives, including whether they seek guaranteed income, tax-deferred growth, or other specific features. Risk tolerance plays a significant role, as it will determine whether a fixed, variable, or indexed annuity is most appropriate, while the other options might be relevant in specific contexts. E.g., reviewing existing annuities, understanding the client's tax situation. They are secondary to aligning the product with the client's overall financial plan. Question 4. Which of the following best describes the benefit of a guaranteed minimum withdrawal benefit and a variable annuity? A. It guarantees a minimum withdrawal amount regardless of the performance of the annuity's underlying investments. B. It provides a fixed income stream for life, regardless of the investment performance. C. It allows the annuitant to access their principal without any surrender charges. D. It offers an inflation adjustment to the income payouts every year. Answer A. Explanation. The GMWB rider guarantees that the annuitant can withdraw a minimum amount from the annuity even if the underlying investments perform poorly. It provides a safeguard to ensure a minimum level of withdrawals over time. This is different from a fixed income stream, as the GMWB rider allows the withdrawals to continue even if the account balance is depleted due to poor market performance, but only up to a certain amount. Options B, C, and D describe benefits that are either not relevant to the GMWB rider or pertain to other annuity features. Question 5. Which of the following statements about the tax treatment of annuities in the US is correct? A. Annuity earnings grow tax-deferred, but withdrawals are taxed as ordinary income. B. The initial investment in an annuity is tax-deferred, but all withdrawals are tax-free. C. Annuity withdrawals before the age of 591 are exempt from a 10% penalty if they are used for medical expenses. D. Annuities are not subject to any taxes until the annuity's death benefit is paid out. Answer A. Explanation. Annuities grow tax-deferred, meaning the earnings are not taxed until they are withdrawn. When withdrawals are made, the earnings are taxed as ordinary income, not capital gains. This is a key feature of annuities that provides tax-deferred growth during the accumulation phase. Option B is incorrect because the initial investment is not tax-deferred, but only the earnings grow tax-deferred. Option C is incorrect because early withdrawals before age 591 were subject to a 10% penalty unless an exception applies. Option D is incorrect because annuities are taxed based on withdrawals, not just at the time the death benefit is paid. Question 6. Which of the following is true about the life-only settlement option for an annuity? A. Payments will continue for the annuitant's lifetime, but there are no beneficiary payments upon the annuitant's death. B. Payments are fixed for a set period and will stop if the annuitant dies before the period ends. C. Payments are guaranteed for a set period, but if the annuitant dies, payments continue to the beneficiary. D. Payments continue to the annuitant's beneficiaries for life after the annuitant's death. Answer A. Explanation. The life-only settlement option guarantees income for the annuitant's lifetime but does not provide any death benefits. Once the annuitant passes away, payments cease, regardless of whether the annuitant had received payments for a long or short period. Option B describes a period certain option where payments are made for a specific time even if the annuitant dies before the end of that period. Option C describes a life with period certain option where payments are made for a minimum period and if the annuitant dies during that time, the beneficiary continues receiving payments. Option D describes a joint and survivor annuity where payments continue to a beneficiary after the annuitant's death. Question 7. Which of the following annuity types offers the potential for the highest return, but also comes with the greatest investment risk? A. Fixed annuity. B. Fixed indexed annuity. C. Variable annuity. D. Single premium immediate annuity SPIA. Answer C. Explanation. Variable annuities offer the potential for the highest return because the returns are tied to the performance of the underlying investment options sub-accounts, which can include stocks, bonds, and other assets. However, they also carry the greatest risk because the account value fluctuates with market performance, which means the annuitant may experience losses. Fixed annuities and fixed indexed annuities, while offering some growth potential in the latter case, provide less risk. SPIA is typically used for guaranteed income and does not involve investment risk. Question 8. What is the primary advantage of purchasing an annuity within a tax-deferred retirement account, such as an IA? The annuity will avoid all income taxes during the payout phase. B. The annuity will have a higher payout rate compared to other annuities. C. The annuity's earnings grow tax-deferred and are taxed only upon withdrawal. D. The annuity's death benefits are tax-free to the beneficiaries. Answer C. Explanation. The primary advantage of purchasing an annuity within a tax-deferred retirement account is that the annuity's earnings grow tax-deferred and taxes are only due when withdrawals are made. This allows the annuitant to benefit from the compounded growth of the annuity's earnings without immediate taxation. Option A is incorrect because tax deferral only applies during the accumulation phase. Income tax is due upon withdrawal. Option B is incorrect because the payout rate is not directly impacted by the type of retirement account. Option D is not accurate, as death benefits are generally subject to income tax, although other tax considerations may apply. Question 9. What is the main purpose of a premium bonus in an annuity contract? A. To provide a one-time lump sum payment to the beneficiary. B. To add additional value to the annuity contract, typically as a percentage of the premium paid. C. To guarantee a minimum rate of return on the annuity. D. To cover surrender charges that the annuitant may incur. Answer B. Explanation. A premium bonus is a feature in some annuity contracts that adds a percentage of the premium paid by the annuitant to the contract value. For example, an annuity might offer 5% premium bonus, meaning that for every dollar the annuitant deposits, an additional 5% is credited to the account. This bonus provides extra value at the outset of the contract. Option A is incorrect because a premium bonus is not a death benefit. Option C describes a guaranteed minimum interest rate or return, but that is not the purpose of a premium bonus. Option D is incorrect because premium bonuses are unrelated to surrender charges. Question 10. Which of the following statements regarding annuity withdrawals is true under IRS rules? A. Withdrawals from annuities are subject to capital gains tax, not ordinary income tax. B. If withdrawals are made before age 591, they are exempt from the 10% early withdrawal penalty if used for education expenses. C. Withdrawals from an annuity are taxed first on the interest earned, followed by the principal. D. All withdrawals from annuities are taxed as long-term capital gains regardless of the holding period. Answer C. Explanation. Under IRS rules, withdrawals from annuities are taxed on the interest earned first, the last in, first out rule. This means that the earnings are taxed as ordinary income before the principal. Option A is incorrect because annuity earnings are taxed as ordinary income, not capital gains. Option B is incorrect because early withdrawals before age 591 were subject to a 10% penalty, with exceptions for certain situations like disability or medical expenses, not for education expenses. Option D is incorrect because withdrawals from annuities are taxed as ordinary income, not as long-term capital gains. Question 11. Which of the following best describes a life with period certain annuity? Option A. Payments are made for the annuitant's lifetime or for a predetermined period, whichever is longer. B. Payments are made for the annuitant's lifetime with no guarantee of payments after death. C. Payments are made for a fixed period, and if the annuitant dies during that time, payments are made to the beneficiary. D. Payments are made to the annuitant and their beneficiaries for life. Answer A. Explanation. A life with period certain annuity provides payments for the annuitant's lifetime, but also guarantees a minimum number of payments over a certain period, e.g. 10 or 20 years. If the annuitant dies before the end of the specified period, the beneficiary continues receiving payments for the remainder of the period. Option B describes a life-only annuity, and Option C describes a period certain option. Option D describes a joint and survivor annuity. Question 12. Which of the following is a disadvantage of a variable annuity? A. It offers guaranteed income for life regardless of the investment performance. B. It exposes the annuitant to the risk of loss due to market fluctuations. C. It provides tax-free withdrawals. D. It guarantees the annuitant's principal investment will be protected. Answer B. Explanation. The main disadvantage of a variable annuity is that it exposes the annuitant to the risk of loss due to market fluctuations. The value of the annuity depends on the performance of the underlying investment options, and poor market performance can lead to a decrease in the account value. Option A is incorrect because the income is not guaranteed to be fixed in a variable annuity. It depends on market performance. Option C is incorrect as annuities are subject to ordinary income tax. Option D is incorrect because variable annuities do not guarantee principal protection unless a rider is added. Question 13. What is the purpose of a death benefit rider on an annuity? A. To guarantee a minimum income stream for the annuitant's beneficiaries after death. B. To pay the full annuity balance to the beneficiary if the annuitant dies prematurely. C. To provide the annuitant with a tax-free income stream. D. To ensure the annuitant's withdrawals are always tax-deferred after death. Answer B. Explanation. The death benefit rider on an annuity ensures that if the annuitant dies prematurely, their beneficiaries receive at least the original principal or some other specified amount from the annuity. This benefit is typically a feature in variable and fixed indexed annuities. Option A is incorrect because a death benefit does not necessarily guarantee a minimum income stream for beneficiaries. It usually guarantees a lump sum payment. Option C is incorrect as it does not apply to death benefits, and Option D is incorrect because tax deferral ends with the annuitant's death. Question 14. Which of the following types of annuities offers the potential for the highest growth? A. Fixed annuity. B. Fixed indexed annuity. C. Variable annuity. D. Immediate annuity. Answer C. Explanation. A variable annuity offers the highest growth potential because the annuitant can choose from a variety of investment options, stocks, bonds, etc., which can provide higher returns compared to fixed or indexed annuities. However, this also comes with higher risk. Fixed annuities offer guaranteed returns, while fixed indexed annuities link returns to a stock index, providing moderate growth potential. Immediate annuities provide a fixed income stream with no growth potential beyond the payout amount. Question 15. How does a fixed indexed annuity differ from a variable annuity? A. Fixed indexed annuities offer a guaranteed interest rate, while variable annuities do not. B. Fixed indexed annuities are linked to an equity index, while variable annuities invest directly in stocks and bonds. C. Fixed indexed annuities do not allow for withdrawals, while variable annuities do. D. Fixed indexed annuities provide tax-free income, while variable annuities are taxed. Answer B. Explanation. A fixed indexed annuity's return is linked to the performance of a stock market index like the S&P 500, but with a cap on gains and a floor that protects the principal from market losses. In contrast, a variable annuity allows the annuitant to invest directly in sub-accounts that can include stocks, bonds, and mutual funds with no guarantees on returns. Option A is incorrect because fixed indexed annuities may not offer a guaranteed interest rate. They are linked to market performance. Option C is incorrect because both annuities allow for withdrawals. Option D is incorrect because both types of annuities are subject to ordinary income tax. Question 16. Which of the following describes the surrender period in an annuity contract? A. The length of time the annuitant must wait before they can begin receiving payments. B. The time during which the annuitant can make penalty-free withdrawals. C. The time after which the annuitant can cancel the annuity for a refund of premiums. D. The period during which the annuitant faces penalties for withdrawing funds. Answer D. Explanation. The surrender period refers to the time during which the annuitant faces penalties for early withdrawals. If the annuitant takes funds out of the annuity before the end of the surrender period, they may incur surrender charges. These charges gradually decrease over time. Option A refers to the accumulation phase of an annuity, but it is not the surrender period. Option B is incorrect as penalty-free withdrawals are typically allowed only after the surrender period has ended. Option C is incorrect because annuity contracts usually do not offer refunds after the surrender period. Question 17. What is a common benefit of a rider attached to an annuity? A. It guarantees a higher payout rate based on the annuitant's age. B. It provides a tax-free death benefit to the annuitant's beneficiaries. C. It adds additional benefits or features to the annuity for an additional cost. D. It guarantees the annuitant will not experience market losses. Answer C. Explanation. A rider is an optional feature that can be added to an annuity for an additional cost. Riders can offer various benefits such as guaranteed income for life, long-term care benefits, or protection against market loss, e.g. a guaranteed minimum withdrawal benefit or a death benefit. Option A is incorrect because payout rates are not typically tied to age through a rider. Option B is not a common feature for most riders, though death benefits may exist in some cases. Option D may be true for certain riders, but not all annuity riders guarantee market loss protection. Question 18. Which of the following is true regarding the 10% penalty on early withdrawals from an annuity? A. It applies only to variable annuities, not fixed annuities. B. It applies to withdrawals made before age 591 unless an exception applies. C. It is waived for withdrawals used to pay for college tuition. D. It applies only to the interest earnings from the annuity, not the principal. Answer B. Explanation. The 10% penalty applies to early withdrawals before age 591 from most annuities unless a specific exception applies, e.g. disability, death, or certain medical expenses. This penalty is applied to the entire withdrawal, including both principal and earnings. Option A is incorrect because the penalty applies to both variable and fixed annuities. Option C is incorrect as the penalty is not waived for college tuition. Option D is incorrect because the penalty applies to the entire withdrawal, not just the earnings. Question 19. What is a primary advantage of a single premium immediate annuity? SPIA. A. It guarantees a fixed income for life with a single lump sum payment. B. It allows the annuitant to make withdrawals at any time without penalties. C. It provides the potential for investment growth linked to the performance of stock indices. D. It allows for tax-free withdrawals during the accumulation phase. Answer A. Explanation. A single premium immediate annuity SPIA provides a fixed income stream starting immediately after a lump sum payment is made. This type of annuity is designed to provide predictable income for the annuitant for a specified period or for life, depending on the contract. Option B is incorrect because SPIAs do not allow penalty-free withdrawals as they are designed to provide income. Option C describes a variable annuity, not a SPIA. Option D is incorrect because SPIs do not offer tax-free withdrawals during the accumulation phase. Question 20. Which of the following is a key characteristic of a fixed annuity? A. The annuitant's payments are directly tied to the performance of the stock market. B. The annuity provides guaranteed income payments that do not fluctuate with market conditions. C. The annuitant can make withdrawals at any time without facing any penalties. D. The annuity offers the highest growth potential but also carries the most risk. Answer B. Explanation. A fixed annuity provides guaranteed income payments that do not fluctuate based on the performance of the stock market. The payments are predetermined and typically remain the same for the duration of the annuity. This offers stability and security for the annuitant. Option A describes a variable annuity where the value of the annuity depends on the performance of underlying investments. Option C is incorrect because fixed annuities usually have a surrender period during which withdrawals may incur penalties. Option D describes a variable annuity which has higher growth potential but also more risk. Question 21. Which of the following is true about the tax treatment of annuities in the U.S.? A. Annuity withdrawals are always taxed as capital gains. B. The interest earned on annuities grows tax-deferred until withdrawn. C. Annuities are tax-free upon withdrawal if the investor is over 591 years old. D. Annuity premiums are tax-deductible when purchased through an employer. Answer B. Explanation. Annuities offer tax-deferred growth, meaning that the interest or earnings on the annuity do not get taxed until they are withdrawn. This allows the annuity's value to grow without being impacted by taxes in the accumulation phase. Option A is incorrect as annuity withdrawals are generally taxed as ordinary income, not capital gains. Option C is incorrect because the age 591 rule applies to early withdrawals from retirement accounts like IRAs or 401ks, not annuities. Option D is incorrect because annuity premiums are generally not tax deductible except in specific situations such as employer-sponsored plans. Question 22. Mr. Davis, age 62, has invested in a deferred fixed annuity with a 7-year surrender period. He needs to withdraw a portion of his funds for an emergency. Which of the following actions will likely occur? A. He can withdraw the funds without any penalties. B. He will incur a surrender charge if he withdraws funds before the 7 years are over. C. The annuity provider will give him a loan instead of a withdrawal. D. The annuity will provide him with a lifetime income stream without penalty. Answer B. Explanation. In a deferred fixed annuity, if Mr. Davis withdraws funds before the surrender period ends, in this case 7 years, he will most likely incur surrender charge, which is a penalty for early withdrawal. This is common in fixed annuity contracts. Option A is incorrect because there is typically a penalty for early withdrawal during the surrender period. Option C is incorrect because annuity contracts generally do not allow loans against the balance. Option D is incorrect because lifetime income streams typically begin after the annuity contract has matured or the annuitant has reached a certain age. Question 23. Which of the following is NOT? A benefit of a variable annuity with a guaranteed minimum withdrawal benefit provides income regardless of the performance of underlying investments. B. Allows the annuitant to withdraw a specified amount of income each year for a set period. C. Offers protection from market volatility by guaranteeing a minimum level of withdrawals. D. Guarantees a fixed interest rate on the annuity value. Answer D. Explanation. A variable annuity with a guaranteed minimum withdrawal benefit does not guarantee a fixed interest rate on the annuity's value. The value of the annuity depends on the performance of the underlying investments, which can fluctuate with market conditions. However, the GMWB ensures that the annuitant can withdraw a minimum amount of money each year, regardless of the market performance. Option A, B, and C correctly describe features of a GMWB, but option D is incorrect because there is no fixed interest rate guarantee with variable annuities. Question 24. Which of the following is a key feature of a fixed indexed annuity? A. It provides guaranteed returns based on a fixed interest rate. B. It links the growth of the annuity to a stock market index, such as the S&P 500, with limitations on returns. C. It allows the annuitant to choose individual stock investments for the annuity's growth. D. It offers a fixed payout rate for the annuitant's lifetime. Answer B. Explanation. A fixed indexed annuity links the annuity's value to the performance of a stock market index, such as the S&P 500. While the returns are tied to the index's performance, there are typically caps, participation rates, and spreads that limit the amount of return the annuitant can earn. Option A describes a fixed annuity, not an indexed annuity. Option C describes a variable annuity, not an indexed annuity. Option D describes a fixed annuity with a lifetime payout feature, which is not a characteristic of fixed indexed annuities. Question 25. Which of the following riders would provide additional protection against inflation in an annuity? A. Long-term care rider. B. Inflation rider. C. Guaranteed minimum income benefit GMIB. D. Death benefit rider. Answer B. Explanation. An inflation rider is designed to protect the value of an annuity against inflation. It adjusts the annuity's payout over time to keep pace with inflation, which helps preserve the purchasing power of the income. Option A is incorrect because the long-term care rider is for providing benefits in case the annuitant requires long-term care. Option C is incorrect because the GMIB provides a minimum level of income but does not account for inflation. Option D is incorrect because the death benefit rider ensures that beneficiaries receive a payment upon the annuitant's death. Question 26. Which of the following best describes the concept of annuity suitability? A. The annuity must be suitable for the insurer based on their business model. B. The annuity must match the financial needs, goals, and circumstances of the client. C. The annuity must be the most profitable product for the insurance agent to sell. D. The annuity must offer the highest possible return to the annuitant. Answer B. Explanation. Annuity suitability requires that the annuity selected by an agent be appropriate for the client's financial goals, risk tolerance, and circumstances. It is a critical aspect of the suitability standards that prevent unsuitable sales of annuities to consumers. Option A is incorrect because suitability refers to the needs of the client, not the insurer. Option C is incorrect because the agent's interests should not drive suitability. The client's best interest is the priority. Option D is incorrect because high returns do not necessarily mean that an annuity is suitable for the client's needs. Question 27. Which of the following is true about annuity death benefits? A. The death benefit is typically equal to the total premiums paid minus any withdrawals. B. Death benefits are always paid out as a lump sum to the beneficiary. C. Death benefits are generally taxable as capital gains. D. Death benefits are only available if the annuitant has reached a certain age. Answer A. Explanation. The death benefit of an annuity is generally equal to the total premiums paid into the annuity less any withdrawals made before the annuitant's death. This is designed to ensure that the beneficiary receives at least the amount invested. Option B is incorrect because death benefits can be paid as a lump sum or in other forms depending on the annuity contract. Option C is incorrect because death benefits are typically subject to ordinary income tax, not capital gains tax. Option D is incorrect because death benefits are available regardless of the annuitant's age, assuming the contract terms allow for them. Question 28. What is the primary benefit of using an annuity as part of a retirement plan? A. It provides a guaranteed lifetime income stream, regardless of market conditions. B. It allows unlimited withdrawals without tax penalties. C. It is the only investment that offers tax-deferred growth. D. It offers a higher growth rate than traditional retirement accounts. Answer A. Explanation. The primary benefit of an annuity in a retirement plan is its ability to provide a guaranteed lifetime income stream, which offers financial security in retirement. This is a key reason many people use annuities for retirement. Option B is incorrect because withdrawals from an annuity may be subject to penalties or taxes, especially before reaching age 591. Option C is incorrect because there are other tax-deferred investment options, such as IRS and 401(k)s. Option D is incorrect because annuities do not necessarily offer higher growth rates compared to other investment options. Question 29. Which of the following types of annuities is most appropriate for someone looking for a guaranteed income stream for life with no concern for market fluctuations? A. Fixed indexed annuity. B. Variable annuity. C. Immediate fixed annuity. D. Deferred variable annuity. Answer C. Explanation. An immediate fixed annuity is ideal for someone who wants a guaranteed income stream for life with no concern for market fluctuations. The income from this type of annuity is fixed and will not be affected by changes in the market. Option A is incorrect because fixed indexed annuities are tied to a stock market index and their returns can fluctuate. Option B is incorrect because variable annuities depend on the performance of investments and involve market risk. Option D is incorrect because a deferred variable annuity also depends on investment performance and income is not guaranteed. Question 30. What is a key disadvantage of using an annuity to fund retirement? A. Annuities generally provide higher returns than mutual funds. B. Annuities offer tax-deferred growth in income. C. Annuities can involve high fees and penalties for early withdrawal. D. Annuities are highly liquid and flexible. Answer C. Explanation. A key disadvantage of annuities is that they often involve high fees and penalties for early withdrawal, particularly in the early years of the contract. This can make it difficult for annuitants to access their funds when needed. Option A is incorrect because annuities typically do not provide higher returns than mutual funds. Option B is incorrect because while tax-deferred growth is the benefit of annuities, it is not the key disadvantage. Option D is incorrect because annuities are generally less liquid and flexible compared to other investment vehicles.